Okay, in this video, I'm going to talk briefly about universal life insurance. So for universal life insurance, what we have is essentially a term life insurance component plus some accumulation of cash value. So basically kind of what happens here is sort of a multi-step process. So when the insured person pays premiums to purchase the universal life insurance policy, it goes into something called a cash accumulation account. Now, once those premiums have gone into the cash accumulation account, from that account is taken money to pay for essentially a term style of life insurance policy. So basically, you pay money into the cash accumulation account, then money is taken from that to pay for, in essence, term life insurance, and also insurance company expenses. And then the remaining amount of cash that's in that accumulation account is essentially generating some return typically and gaining in value. Now, as a result of that, over time, what happens is ideally the money in that cash accumulation account will actually grow, and that's what produces the cash value that belongs to the insured individual. There is also the insurance policy, which is sort of a term style policy that was purchased with the money that went into that account, or at least some of it. And so what you have is at death, there are sort of two components to the insurance policy. One, the money that, or the death benefit that's coming from the insurance policy that was purchased, plus whatever is in that cash accumulation account. Now, if there's enough money that is accumulated in the cash accumulation account, it's possible in some circumstances that the person who's insured may actually be able to stop paying premiums for a period of time, as long as there's enough money in that cash accumulation account to continue paying the premiums for the insurance policy. So that's a possibility. Now, with universal life policies, there are actually sort of two ways that they can handle that death benefit versus what's going on in the cash accumulation account. So we have option A and option B. So let's talk about those. So for option A, generally what will happen is you'll have a mostly constant, okay, so generally pretty constant death benefit. And then you will have a gradually growing sort of cash value. Okay, so you have sort of a constant death benefit and then a gradually growing cash value. And in that case, that gap between that constant death benefit and the gradually going cash value that gap is basically the risk that the insurance company has. Because in essence, when you have paid for the policy, you paid for your premiums, the policy's in effect. If you die 2 days later, they have to pay out the full insurance amount. You haven't built up any cash value, and basically they just have to take the full hit financially. But down the road, if we're looking at a situation where that cash value has increased over time, by the time we get to that period over here, where really there's money sitting in that account, then what's happening there is basically the amount that the insurance company is going to have to come up with to pay out the specified amount is a lot lower. And so basically they're going to give you the cash account plus whatever they need to on top of that to make up the total death benefit. And if enough time has gone by, there's not a whole lot of risk there. Now, even in that case, what can happen is a situation in which we get to a point at which the cash value has risen and it's real close to the death benefit. So if that has occurred, where it's really close to the death benefit, then what's going to occur at that point is basically they're going to have to start increasing the death benefit, or in other words, how much they're going to pay out total. The reason why they have to do that is if the cash account increased above the total death benefit, then the insurance company wouldn't actually have any money at risk, because basically they just give you the cash account and walk away when you die, and they don't have any risk associated with you dying. And if that's the case, then this is no longer really insurance, and this is really just sort of turned into an investment at that point for you. And so because there's no what they'll call actuarial risk in that circumstance, it wouldn't be considered insurance. So that produces an interesting side effect for universal life insurance, and that is if the cash value grows fast enough, it could actually eventually down the road trigger a point at which that high cash value makes it necessary for them to increase the total death benefit. And the reason why that's kind of an interesting result is if you have a high cash value, then technically from a budgeting and financial planning standpoint, you probably need less additional coverage because you already have that coverage built up. So it can kind of produce this counterintuitive result, which is I have more money on hand now in that cash value, which should mean I would need less insurance, but now I'm going to have to buy more insurance because the insurance actually has to exceed, or the death benefit, I should say, has to exceed the cash value in the policy by a certain amount, or else basically this is not considered insurance anymore, and that creates, tax issues and so on and so forth. Now, for the option A policy, basically what started out was kind of that stable death benefit. Cash value slowly increased here. Eventually, I could hit a point at which I need to start increasing the death benefit to make sure the death benefit stays above that. Option B policies start out a bit different. So for option B policies, typically what will happen is both the cash value and the death benefit are typically increasing. So in that case, this would look a little bit more like the death benefit's gradually going up, the cash value is gradually going up, and that gap between them is the piece that the insurance company has at risk. So for the option B policy, what you're going to have is a situation in which the insurance company is going to have basically this gap that's at risk. But the reality is for option B policies, that gap never really goes away. And so because the death benefit is increasing and the cash value is increasing, and we constantly have that gap between them, then in that case, for option B policies, very commonly the overall total amount you would pay in lifetime premiums will probably be higher because for the insurance company, you pose basically a risk to them financially that doesn't really go away. In the option A policies, initially you're a financial risk because they promise that they're going to pay this amount of the cash value down here. But eventually that gap pretty much closes to the point that if you die at that point, they don't really incur a financial hit. The money's sitting in that cash account already. So for option B policies over the lifetime of the policy, it's going to pose probably a higher risk to the insurance company and therefore result in higher premiums. Okay, hopefully that helps a little bit with universal life insurance, and hopefully it makes a little bit of sense. Thank you so much for watching. Have a great day.